Hi CA students, let's revise CA Final AFM Chapter 6 Portfolio Management Practical Question 41. The following are the data on 5 mutual funds. The funds are given and the return is given, standard deviation is given and beta is given for the respective funds. You are required to compute reward to volatility ratio and rank these portfolios using Sharpe method and trainers method. So reward to portfolio, the reward to volatility ratio. Volatility is nothing but risk, and reward is the extra return which we are getting compared to the risk-free return. So extra return. Okay. Now they are asking us to rank these portfolios using Sharpe method and trainers method. Trainers method gives us the per unit risk return of a portfolio, per unit risk return, the extra return of a portfolio. So as we can see in the formula itself, the return of portfolio minus the risk free return will give us the extra return which we are earning over and above the risk free return. Let's say if portfolio's return is 13% and the risk free return which in the market is available, like treasury bills return is some 10%, then our portfolio is earning 3% extra more than the risk free return. And this okay, now this extra return we are earning, and how much is the per unit extra return we are earning for the risk, total risk. In case of Sharpe ratio, it is the standard deviation of portfolio, which is nothing but the risk for the portfolio. So if we are dividing this by the standard deviation, which is nothing but the, so this can be considered as the total risk. So let's say in our case here, if the risk percentage is around 5 or 10, then we are earning 0.3% of return, extra return for every 1 rupee risk we are taking. That is the idea here. Now in case of trainers ratio, that is also same, the extra return, but it will be divided by the portfolio, beta of the portfolio. So what this signifies, beta is nothing but the sensitivity of the stocks return towards the market return. So the sensitivity of stock towards the market return, which basically says only the systematic risk portion of a stock. That's what trainer assumption is. So what will be the difference between Sharpe ratio and trainers ratio? In Sharpe ratio, the total risk of the security is considered, but trainer is considering only the systematic risk of the stock. Why? Because as we have seen in our previous questions also and in previous videos, the unsystematic risk of a portfolio, of a stocks return in a portfolio, can be eliminated by diversification. Let's say in a portfolio, if we have 4 to 5 stocks, and if we want to reduce the unsystematic portion of risk, then we will be diversifying the risk in different streams. So in that case, the unsystematic of a portfolio will get reduced, and then only the systematic portion prevails. Systematic portion is nothing but the, as we have told, the sensitivity towards the market returns, so which we cannot eliminate. Thus in case of trainer, we are considering only systematic risk. So the extra return we are earning per systematic risk, per unit of systematic risk. In case of Sharpe ratio, it is extra return earned per total risk, per unit of a total risk of a portfolio. That's it. Okay, now keeping these things, that's what even they are asking us to calculate also. Reward to volatility ratio. Volatility is nothing but the standard deviation. Standard deviation is nothing but the risk of a portfolio, and reward is the extra return which we are earning more than the risk free return. Okay. Now they have given risk-free return in our case as 6%. So over and above 6%, whatever we are earning, that will be the reward. And they have given the standard deviation also. So that will be the risk. Okay. Now first using Sharpe ratio, we have return of portfolio RP, return of the stock, then return of the risk free return, then minus that will give us the reward. So this will be the reward or the extra return which we are talking about now. Extra return, and the standard deviation is the volatility. Okay, now the extra return divided by the volatility will give us the reward to variability or reward to volatility. And ranking, so whatever is the highest one will give us the first rank, because for the least amount of risk it is giving more return. Let's say in terms of rupees or something, for 1 rupee, in this case for 1 rupee of risk, 1 unit of risk, stock C, mutual fund C is giving 1.6 percentage extra. But if you go to the second one, mutual fund A is giving only 1.28, and the third one 1.20. B is giving only 1.20 for every 1 unit of risk, and E is giving 1.11 percentage of risk for every 1 rupee. Same case goes with D. Okay. Now this will be the ranking. Now reward to volatility trainers ratio, which will be the second requirement. As we know, in case of trainers ratio, we have to use beta instead of the standard deviation. Beta indirectly signifies the systematic risk portion. Systematic risk portion. So this RP minus RF is the reward which we are talking about. So 15 minus 6, this we have already calculated in the above table. Same thing we can plot it here. Then we have to just divide, and then denominator will changes. So here the ranking changes. Mutual fund B is the first rank, having 16% as the extra return, and second one is A 7.2, third one is E 6.67, fourth one is 6.12, and third one C will be the fifth one, 5.71%. So as we can see from the above perspectives, if we compare the values using Sharpe model, C is taking place as the first place. The mutual fund C has the first place. But in case of the trainers ratio, C is taking the fifth place. It ultimately going to the last. This is because the systematic portion of the return is too high, or what you say. The extra return we are earning for the systematic risk is so less. The other portion, unsystematic portion, can be diversified, but even if we diversify, the systematic risk portion is high in case of mutual fund C. Hence it is almost consuming all the extra return which we are earning. Hence this is Sharpe ratio and Trainers ratio. Thank you.